A high APY can make you feel like your cash is already optimized. But on a $20,000 balance, $850 of gross interest can translate to roughly $146 in simplified after tax, after inflation purchasing power gain, under the assumptions we'll use in a moment. That gap is where disciplined cash management starts. When I say wealthy people, I don't mean every wealthy person follows the same 7 rules. They don't. The useful idea is that people who manage large cash balances well tend to focus on systems, safety, access, taxes, inflation, and whether the account is still doing the job it was chosen to do. So here are 7 things disciplined cash managers generally avoid doing with money in a high-yield savings account. First, they don't treat the APY like a permanent promise. With a variable rate HYSA, the bank can change the interest rate and the APY can move with it. The Consumer Financial Protection Bureau requires variable rate account disclosures to tell you that the interest rate and APY may change. That matters. A 4.25% APY on the day you open the account does not mean you are guaranteed 4.25% for the next 12 months. If the rate falls later, your actual interest will be lower than the simple number you pictured on day 1. Second, they don't treat the advertised APY as guaranteed personal earnings. APY is an annualized measure that reflects both the interest rate and the effect of compounding. It helps you compare deposit accounts, but for a variable rate account, it is not a promise that you will personally earn that exact percentage over the next 12 months, especially if the rate changes or your balance changes during the year. So use APY as a comparison tool, not a guaranteed personal result. Third, they don't choose an account by the highest APY alone. Imagine Bank A pays slightly more, but transfers back to your checking account take longer than you are comfortable with. Bank B pays a little less, but gives you faster access, has no monthly maintenance fee, and fits the way you actually move money. If this is emergency cash, access is part of the return. A few extra dollars of interest are not very impressive if getting your money creates friction exactly when you need it. And check the details: minimum balance requirements, monthly fees, transaction rules, transfer limits, withdrawal methods. The federal 6 transfer per month limit that people still repeat online was deleted from Regulation D in 2020, but that does not mean every bank has identical policies. An institution can still set its own account terms, so you need to read the actual rules for the account you use. A higher APY can be a good thing, it is just not the only thing. Fourth, they don't keep all their cash in checking just because checking is convenient. Checking accounts are built for transactions, rent, credit cards, utilities, groceries. The money you expect to spend soon belongs somewhere easy to reach. But cash you do not need for this month's bills may have a different job. If your emergency fund or short-term reserve can sit safely in an insured HYSA while still remaining accessible enough for your needs, leaving that entire balance in a low-yield checking account can create an opportunity cost. The key is not checking bad, HYSA good. The key is segmentation. Keep your operating cash where you pay bills. Keep your reserve cash where it can stay protected, reasonably liquid, and competitive on yield. Wealthy cash management is often less about finding one magical account and more about giving each dollar a specific job. Fifth, they don't put all their cash into a product before understanding what protection actually applies. This is where names can fool you. A money market deposit account at an FDIC-insured bank is a bank deposit. A money market fund is an investment fund. Those are not the same product, and a money market fund is not FDIC-insured. The same caution applies to anything described as a cash account, cash management account, sweep, or high-yield product. The label on the front page is not enough. You need to know what legal product you own and where the money is actually held. For an FDIC-insured bank, the standard deposit insurance amount is $250,000 per depositor, per insured bank, per ownership category. Federally insured credit unions use NCUA share insurance with a similar $250,000 framework that depends on ownership structure. So, do not assume the letters HYSA automatically equal FDIC insurance. Confirm the institution. Confirm the product. Confirm how the account is titled. And if your cash balance is large, understand how the ownership category affects coverage. That brings us to the number that can look great on your statement, but much smaller in real life. Sixth, they don't judge a HYSA by gross interest alone. Let's use a purely illustrative example. Say you keep $20,000 in a HYSA, and for the sake of simple math, assume it earns 4.25% over a full year. That is about $850 of gross interest. $850 sounds like the result. It is not necessarily the result. Most ordinary bank interest is generally taxable for U.S. federal income tax purposes. So if we use a hypothetical 24% federal tax rate only for illustration, $850 of gross interest becomes about $646 after federal tax. You did not lose the interest. You simply have to distinguish gross income from after-tax income, and your own tax situation may be different. State and local taxes can matter too, depending on where you live. This is an example, not individualized tax advice. And taxes are only half the story. They also don't ignore inflation when deciding whether their cash is actually gaining purchasing power. Take that same $20,000 example. We had about $646 left after our hypothetical federal tax calculation. Now assume, only for illustration, a 2.5% inflation effect on the $20,000 principal over that period. 2.5% of $20,000 is $500. So the rough purchasing power math becomes $646 minus $500. That leaves about $146. The statement showed $850 of gross interest. The simplified real cash gain is roughly $146. That is a completely different emotional experience. And here is the useful approximation. Real cash gain is approximately interest after tax minus inflation effect. This is not an official CFPB, IRS, Federal Reserve, or BLS formula. It is a simplified way to think about what your cash earned after taxes and what inflation did to purchasing power. Now, change just one assumption. Suppose the same $20,000 earns 3.5% instead. Gross interest is about $700. With the same hypothetical 24% federal tax rate, that becomes about $532 after tax. Subtract the same illustrative $500 inflation effect, and the approximate real cash gain is only $32. $700 on the statement, roughly $32 in this simplified real gain calculation. And it can go negative. Suppose $20,000 earns 3%, producing about $600 gross interest. Use a hypothetical 32% federal tax rate and you are left with about $408 after federal tax. Then assume 3% inflation, an effect of about $600 on $20,000. 408 minus 600 gives an approximate real cash gain of negative $192. Your bank balance still went up. Your purchasing power under those assumptions did not. That is why disciplined cash managers ask a better question than how much interest did I earn? They ask, what did I keep? And what can that money still buy? Seventh, they don't set the account and forget it after rates change. A HYSA that was highly competitive when you opened it can become ordinary later. Banks change rates. Competitors change rates. Your own needs can change too. But this does not mean you should move your emergency fund every time another bank advertises a tiny APY advantage. Chasing every small difference can create more friction than value. Instead, build a low-maintenance review habit. Check the APY periodically, and pay attention when your bank notifies you of a meaningful rate change. Then compare the whole package again: yield, access, fees, minimums, transfer rules, and insurance protection. This is where the 7 rules turn into a simple cash management system. First, define the job of your cash. Money for this month's spending is not the same as money for an emergency 6 months from now. Second, verify the product. Know the institution, the insurance structure, the ownership category, and the applicable limits. Third, check access. How do you move the money? How long can it take? What transaction rules or fees could matter when you need it? Fourth, check the current APY and whether it is variable. Fifth, run the after-tax, after-inflation approximation instead of staring only at gross interest. And sixth, review the setup again when rates or your circumstances change. Picture Maya. She keeps a $20,000 emergency reserve and feels good because the headline APY looks strong. Then she runs the math and realizes the $850 gross interest story can become roughly $646 after a hypothetical tax assumption and about $146 after an illustrative inflation effect. Her account is not bad. Her measurement was incomplete. Then there is Chris. He keeps nearly all his extra cash in checking because everything is in one place. Instead of moving every dollar, he leaves enough for near-term bills and moves only the reserve portion into an insured HYSA that gives him the access he needs. He is not chasing a secret account. He is separating spending cash from reserve cash. And Jordan sees an attractive yield inside a cash-like product. Before moving the money, Jordan checks whether it is an FDIC-insured bank deposit, an NCUA-insured credit union share account, a brokerage sweep, or a money market fund. That one step matters more than the marketing word cash. The bigger lesson is that the highest APY is not automatically the best place for your cash. The better target is a combination: appropriate protection, reliable access, low friction, competitive yield, and a result that still makes sense after tax and inflation. So do 3 things today. Check the current APY on your HYSA and confirm whether it is variable. Read the fee, minimum balance, transaction, transfer, and insurance terms. Then take your own cash balance and run this approximation. Real cash gain is approximately interest after tax minus inflation effect. And if you think a HYSA, a money market deposit account, and a money market fund are basically 3 versions of the same thing, that is the next distinction you need to see, because one word in the product name can completely change what is insured, how liquid the money is, and what risk you are actually taking.